Okay, we're now live. I'm just going to give it a moment while people join and then we'll go ahead and get started. Okay, I know we have a lot to cover here, so we'll be timely. Good afternoon, everyone, and thank you for joining today's webinar, Generation Skipping Trusts, Preserving Wealth Across Generations. We're pleased to be joined by Steve Galli, Chief Investment Officer and Wealth Management Advisor, and Damien Paumi, Wealth Management Advisor with Nisabachi Wealth Advisors and Wealthspring Financial Partners, along with Matthew Rheingold, attorney and partner at Einhorn, Barbarito, Frost, Botwinick, Nunn, and Musmanno, where he serves as co-chair in the Trust and Estates and Taxation Practice Groups. Please feel free to submit any questions you might have using the Q&A feature throughout the presentation, and we will do our best to address them at the end. So with that, I will pass it over to Steve to get us started.
Thank you, as always, Katie, and thank you all for joining us today. I trust that you will find this informative, and we do especially welcome Matt Rheingold to join us, who we do a lot of work with, and I'm really looking forward to his contribution to the presentation today. So, what we're going to cover today is we'll just do a quick history lesson, followed by a discussion of a generation skipping trust, as well as then transition into dynasty trusts. And then, as Katie mentioned at the end, we will have time for Q&A, so feel free to type in those questions as we go, and we will do our best to address them. We do want this to be interactive if possible. So, not sure if many people are aware, but Cornelius Vanderbilt of the Vanderbilt fortune fame, he was a shipping and railroad mogul. He actually died in 1877. At the time, he had a $105 million estate that was passed on to 13 children. I mean, in today's dollars, that would be billions and billions of dollars. He was the richest man in the world at the time, but it didn't end well. Less than 100 years later, there wasn't almost any money left. So clearly, Cornelius did not have an excellent estate planning attorney or financial advisor. So this is what we want to talk about today, and how there are creative ways to prevent such a calamity for your future generations. So the bottom line is the federal government, wants to make it difficult for wealthy families to pass on their wealth again and again and again down the line. So basically, there is what is known as a estate tax, which is quite high at a federal level, up to 40% on gifts and transfers at death. So, what if we can be creative about avoiding this tax? So before we talk about that, first, what is the GST tax? Well, the GST tax is very similar to the estate tax. It is a flat 40% tax on any transfers to skip persons, which is generally considered, grandchildren or more remote descendants. It operates right alongside the estate and gift tax system, so very similar tax. And all GST transfers are taxable gifts, but not all taxable gifts trigger the GST tax. And that's how we get into the point of exclusions and exemptions, and also the portability issue. And on this, I will let Matt comment on why this is an important point about the lack of portability.
Essentially, each individual has a GST exemption that's currently aligned with the estate and gift tax exemption. That's $15 million per person under current law, or $30 million per couple. But there are some important nuances, particularly around portability, that distinguish GST planning from regular estate planning. Transfers must first be taxable gifts before the GST tax can apply. Payments are made directly to educational institutions or medical providers are excluded. The annual exclusion, that's $19,000 per person in 2026, is limited application in the GST context and does not apply to most trust structures. But importantly, unlike the federal estate tax and the gift tax, the GST exemption is not portable between spouses. So if a spouse dies without using their GST exemption, it is lost permanently. It is one of the most important planning distinctions we can share with you today. With the regular estate tax, if your spouse dies first without using their exemption, you can't port it. In other words, claim it on the survivor's return and effectively double the exemption. In other words, we can't double and get the $15 million exemption by merely filing the tax return. But with GST exemption, it doesn't apply. If your spouse does not use it, it's gone forever. This is why we often recommend that both spouses fund GST trusts, even in situations where you might otherwise rely on portability for estate tax purposes. The use it or lose it nature of the GST exemption creates urgency for married couples. So funding a GST trust is imperative.
All right. Excellent points. So now, as we just mentioned, right now, the federal estate exclusion amount, the lifetime exclusion amount is $15 million per person, which means for couples, it's actually $30 million. Meaning, if you are a couple, you have the ability to pass on a very sizable estate without incurring the estate tax. But that doesn't mean it will always stay at that large amount. So, and this has happened in the past, obviously, where in some years there was no exclusion at all. In some years there was an unlimited exclusion. Unfortunately, when one of my parents died, actually this number was a lot lower. So it's not always necessarily going to be at this amount. And so I think one of the reasons why we're pointing this out is that because this is a large amount today, there are steps that people can take today to actually lock in this very large exclusion amount. So with that, let's talk about what exactly is a generation skipping trust. Well, essentially, a GST, it allows you to transfer wealth to later generations, and it basically skips an entire layer of estate tax that would otherwise apply at your children's death. So the steps are essentially you fund the trust, and you can fund the trust with pretty much anything you want, cash, securities, real estate, and you would fund the trust using that $15 million lifetime exemption. And when you do that, those assets leave your taxable estate permanently. The nice thing is that your children actually can benefit from this trust. They can receive income from it if needed. They can get principal distributions if needed during their lifetimes. And this trust is usually managed by a trustee based upon your instructions. And you can indicate whether or not you want your children to be able to benefit from the trust like that. And then, of course, upon your death, and at your children's death, the assets pass on to the grandchildren without triggering another round of estate taxes. So that is the skip. That is how we avoid the double taxation of the estate. Does anyone want to comment on those kind of steps right there?
Let me just add that the trust ensures that when your children pass away, the remaining assets flow to the grandchildren without the IRS taking a 40% bite at every single generation. That's how we build upon. The trust is irrevocable. Assets contributed are permanent. The irrevocability is what we find that gives clients pause. But don't think of it that way. It's the price of admission. The irrevocability is what's needed in order for the assets to be removed from the estate. The IRS won't let you have it both ways, so you can't retain full control over assets and also claim that they're no longer part of your estate. But we include funding mechanisms, flexibility mechanisms. We'll talk about more of that later, which include the trust protectors, decanting provisions, broad trustee discretion that provide adaptability that are within the irrevocable structure. So you give away the assets, and we still have some of the flexibility that remain, so that you still can help manage the assets with the trustee.
All right,
And
excellent.
I'd add one comment onto that. So where oftentimes we see this a lot is when, a parent's generation has adult children, and oftentimes one or more of those adult children don't have any children, but yet they ultimately want to leave this to their bloodline grandchildren. So think I have three children. One of my adult children does not have children, but my other two do. Is there a way that you can use something like a GST to avoid the inheritance tax that would otherwise be paid, going from that adult child who does not have children to their niece and nephew? And that comes up a lot. And so I didn't know if you wanted to comment on that.
Yeah, no, it's important. It's more of what we're going to get into in actually the next slide, which is probably a good point to get into if you want to skip there right now. Um, and who should consider a generation skipping trust? A common misconception is that it's only for billionaires. It's not the case. It's for those individual clients whose assets are low right now, even sometimes below the $15 million mark, but they're going to grow exponentially. It's not about where you are today. It's about where your assets are going to be in the future, 20 to 30 years from now. It's about the multi-generational goals. It's about families whose wealth want to benefit grandchildren and beyond in their own terms, and about with your own values. It's about appreciating assets. It's about clients holding investments, businesses, or real estate that's likely to grow significantly in the future. The goal is to transfer the growth out of the estate now while it's a seed and let it blossom in the trust. Put it in while it's a small amount, let it blossom in the trust. So we get it utilizing a small amount now inside the trust and let it blossom. The growth is inside the trust, and therefore everything inside that trust is outside of the estate. And it's about asset protection. GSG trust can shield for future generations. It's about protecting it from bankruptcy. It's about protecting it from divorce. It's about protecting it from other creditors. It's not just about tax planning. A lot of what people focus on with taxes, the taxes. I want to save money on taxes. They don't think a lot about the creditor protection. It's not always about tax protection. It's about asset protection. And GST trusts, particularly dynasty trusts, which we'll talk about later, does that.
Excellent points. Thank you. So now let's actually use an example. And this is actually a very familiar example to me. A good married couple I know, George and Martha. They have two kids, Jack and Jill. Now, George and Martha are a pretty successful couple. They currently have an estate that's approximately $8 million. And they have one living parent, Agnes. So Agnes is the grandparent of Jack and Jill. And Agnes, who is the grandparent of Jack and Jill, actually has an estate worth $2 million, which, based with Agnes having her own home and some assets in the bank, it's not an unreasonable scenario that we often see. So, unfortunately, Agnes passes. So Jack and Jill's grandma dies, and in the scenario where they didn't set up a generation skipping trust, well, George and Martha then inherit Agnes's $2 million estate. So George and Martha now have a $10 million estate instead of the $8 million they already had. And that, assuming a 6% average annual growth rate, over 25 years grows to about $43 million. When George and Martha then pass their estate on to their kids, Jack and Jill, at today's federal estate tax rates, that would generate a federal estate tax liability of $5 million. Remember, anything over $30 million is taxed at that 40% rate. But what if they had set up a generation skipping trust, or rather if Agnes had a generation skipping trust provision in her will? Well, with the GST, George and Martha could have said, you know what? We're doing really well. We don't actually need to receive Agnes's $2 million. We would rather put the $2 million into a generation skipping trust for Jack and Jill. So if the GST is funded with Agnes's $2 million, that is now outside George and Martha's estate. So all the growth of that $2 million over the next 25 years grows outside of George and Martha's estate. So assuming the same growth rates, George and Martha's estate grows to $34 million after 25 years. The GST grows to $8.5 million after 25 years. And once George and Martha pass, and pass their estate on to Jack and Jill, well, their estate is $34 million, so they only face an estate tax liability of about $1.7 million. The $8.5 million, there is no estate tax. So basically, by setting up that GST in this scenario, they've saved almost $3.5 million in estate tax liability. That's the power of the GST. So let's get into the mechanics of actually how a GST works.
And just remember that, that assumes in the prior slide, no additional contributions. If you're adding to the trust annually, the numbers get even more compelling.
Yes.
So a GST actually works from, GST, you allocate it, the trust uses the The trust uses the $15 million lifetime exemption. Assets passing to skip persons incur no GST tax if they're properly allocated. So essentially, you add money to the trust, you allocate GST exemption, and anything in the trust at that point that grows, it's free from estate. It's free from GST. It's free from GST tax, no matter the amount that it actually grows to. If it grows to 150 million, it's free from estate tax. It's free from GST tax at that point. What we want to focus on when we talk about these types of trusts is the trustee. More often than not, clients often tell me that they don't want to spend fees. They just want to appoint a friend or a sibling or someone else as a trustee. It's often not the best approach. Some of those individuals do not have the requisite knowledge, and they can do more harm than good. Family members as trustees can work for a single generation, but across 50 or 100 years, institutional continuity matters. I generally recommend corporate or professional trustees for GST and dynasty trusts, particularly for the longer term trusts. Many families often use a directed trust structure with a corporate trustee handling the administration, and then working with an administrator, working with an individual or committee of people directing the investments. Then we're talking about crummy powers. That's annual gifting provisions. You're making those annual gifts, those $19,000 per person that often people hear that I'm only limited to $19,000. You're not. You're only limited to $19,000 and you have to file a gift tax return. You can make more than $19,000 per year to a trust. You just have to file a gift tax return. You have to give someone what's known as crummy power each year, the ability to remove money from the trust on an annual basis. And in other states, there's dynasty protection. In some states, there's a rule against perpetuities. It doesn't exist, and we'll get this more later, in states like Delaware, in Nevada, in South Dakota. We often want to put trusts and locate them in those states so we get longer term protection. Remember, these trusts are irrevocable. We talked about that before. And state estate tax matters. Not all states have no estate tax. New York, for example, if you own property there or if you live there, has a state estate tax that's lower than the federal level. It's about a little over $7 million. So we have a $15 million federal estate tax, and we still have to worry about the state estate tax. You can't just forget about the state estate tax. If you fund a generation skipping tax with $15 million, you may incur estate taxes. We have to worry about that, and we have to factor that in. So these are some of the things that we have to worry about. You have to work with a practitioner. You have to work with your financial advisor to start thinking about these things. Anything you guys want to comment on? Anything you guys want to add?
Excellent points. And I think at this juncture, we can actually transition to the dynasty trust conversation, which I know is actually one of Damien's favorite topics, because this actually takes it to another level. So I will defer to you gentlemen on the nuances here.
Okay. So a dynasty trust is defined by who it benefits. Its beneficiaries 2 or more generations below the grantor. And it's also defined by how long it lasts. It's designed to persist across multiple generations and sometimes in perpetuity. All dynasty trusts should be structured as generation skipping transfer trusts. taking full advantage of GST exemption so assets pass free of transfer tax at every single generational level. Essentially, if you're going through the effort and the cost of establishing an irrevocable trust and you're using GST exemption, from my perspective, why limit it to 2 generations if you can protect your family for more? That's the dynasty trust philosophy. It says it here, they're designed to last 100 years in perpetuity, the layered approach, but the compounding advantage, that bullet point is probably the key here. It cannot be overstated enough. Every time estate tax is not assessed at a generational transfer, that's 40% tax stays in the trust and continues to compound. Over 60, over 90, over 100 plus years, the difference is staggering. You want to go to the next slide?
Absolutely. Great points.
So this is how essentially it works and it operates. The flow of assets in, the protections, the built-in, and how distributions work. This is fundamentally how every dynasty trust, at least the ones that I draft, work. The grantor funds the trust through gifts, through sales, through bequests of assets with GST allocated. The trust can then own life insurance with the premiums paid from trust assets, and the death benefits are then ultimately flowing back to the trust. A dynasty trust that owns life insurance can leverage a relatively modest amount of premium into significant death benefits, all growing inside the trust, free of estate tax. For clients who are insurable, this is an extraordinary wealth creation mechanism. The distributions ultimately, after that life insurance payout or after the assets already in that trust, then flow to the spouse, the second generation, the third generation, and beyond, all tax-free as income or bona fide loans. I want to highlight the bona fide loans concept and this trust because the trust can lend money to beneficiaries for a home purchase, a business startup, or other needs at a fair interest rate. The principal ultimately stays in the trust, but the beneficiary gets the use of the funds and the loan repayment builds the trust assets back up. It's a powerful alternative to outright distributions. I don't like outright distributions to beneficiaries. It causes problems for creditors. It causes problems for divorce. I like loans. So loans back to the beneficiary are key. You're paying your money ultimately back to yourself and back to the beneficiary. The money ultimately stays inside the trust. And the distributions also can be, depending on what the grantor is looking for, can be based upon incentives. It allows the grantor to attach strings, reinforce their values, responsibilities, work ethic. We put those provisions in trusts all the time that they don't want their children, their grandchildren, their great-grandchildren to be trust fund babies. They want them to be bona fide members of society. So we put restrictions on how the money can be used, when money can be distributed. That can be built into the trust. That you're relying on the trustee to ultimately make the decision about whether to make those distributions. But everything can be built in. You're not just giving away your money and ultimately forgetting about it. And importantly, this is the one that we reinforce the most, is the trust can provide asset protection from in-laws, from creditors, and from predators.
Excellent.
Yeah, I was going to make a couple comments on that as to why oftentimes something like this is my favorite and a planning tool to think about. A lot of wealthy clients, as they're going through life, are thinking about how much their assets are worth and what those assets can create from an income perspective. And so it doesn't matter if the number is $2 million, $10 million, or $20 million. And I'll just use $5 million as an example. If a client has, 2 children and they have $10 million and they're going to put $5 million into these trusts for each one of their respective children and or their families in general, sometimes psychologically they start thinking about, like, how much money does my kid actually need? How much money could they actually use? And if you use the rule of a 4% or a 5% distribution rate, there's many of a client who will say, if each one of my children gets $5 million at a 4% distribution rate, which would be about, $200,000 a year, like, how much more should they actually need? If they can borrow from it to buy the shore house, if they can, do all of those things, like, do we want to leave $5 million to each one of those kids and just let them have at it? And I think that goes into, to what Matt was saying. It's how you actually invest that money what you use that money for, and how you plan to replenish the money that you plan on utilizing. There's many, many families that are thinking about this to say, how can I make sure that I can get the protections that I need for the family? And then keep them, bona fide members of society. I think that that is a huge, huge point. It also takes the challenge of I'm going to call it the future marriages out of the equation. And I just wanted to make sure, see if Matt, you had any comments on that. I think a lot of times when you're asking your 20-year-old to potentially come up with a prenup, it's an awkward conversation. If money was in trust and it already has those protections, we really don't need to have as much of that awkward conversation. And I figured, Matt, maybe you could comment on that because that is a big deal.
It is a big deal. I do a lot of prenups, but if we can tie it up at the higher level and we can restrict at the higher level, we don't need it as buttoned up. I like to do both, but not every client likes to do that. They don't like that awkward conversation. Not every spouse or future spouse wants or will agree to that. But if the grandparent can tie it up and put restrictions on that money in certain ways, we can certainly protect that money, at least the trust money, from inherited wealth for creditor protection, for spousal protection, for at least under certain state laws, for alimony and equitable distribution. So let's tie it up on their level. Let's protect that money and let's leave it in trust, because when that money hits the bank account for an outright distribution, you don't know what they're going to do, whether they're going to commingle it, whether they're going to put it into a joint bank account, whether they're going to buy a joint property. But you can be sure that if it's in trust, it's going to be protected. And it's going to be protected from that spouse. It's going to be protected from that creditor. And you're going to rely on that trustee to not make a distribution if it's not warranted.
Great points. We did get a question that came through, and I'm just going to quickly go back to the George and Martha example because I think it's a pretty good question, which is, well, if Agnes, for example, sets up a GST provision in her will, what if George and Martha don't want to put Agnes's estate into the GST? Do they have to?
No, I mean, if they don't want to and they don't have to, it's just going to be added to their overall tax base, and it's going to become part of their estate at that point, and it's going to be subject to estate taxes. You don't have to do anything you don't want to. But if grandma doesn't do it, the proper tax planning, it's going to fall and be potentially exposed to more taxes at that point.
And
Right, and I
that
think
leads me to another question too, which is a lot of times George and Martha, it sounds like they're the more potentially more affluent part of this family. They might have access to different resources and they might have access to knowing about the GST. Are there things that George and Martha can do, to create the GST for Agnes to fund and then say, hey, mom, instead of leaving me and my family, or instead of leaving me and my wife, your assets, is there a way that you'd be willing to put that into this trust that I've created for you, so that this way, you can skip me and get it right to my kids?
Yeah, we revise wills all the time for grandparents at that point. And ensure that if we don't want it to reach a certain level, let's put it into trust. Let's revise grandma's will, in this case, Agnes's will or Agnes's trust, to leave it assets directly to the grandchildren. It makes a lot more fiscal sense. Why are we burdening George and Martha with potential estate and generation skipping taxes in the future when we can completely eliminate the taxes? It's savings. From a fiscal standpoint, it doesn't make any sense. From a practical standpoint, it doesn't make any sense. And if we can explain that to Agnes, and get it and take care of it for her, ultimately, the whole family benefits.
And then one question that I had too is if this was a dynasty trust, and Agnes left the money into a dynasty trust, can George and Martha add to that trust?
Depends on how it's structured. And certainly if Agnes is the one setting it up and Agnes is the one naming a trustee, then potentially if it's Agnes, I'm sorry, if George and Martha are not the beneficiaries, yes, we don't like it. I'd just rather them set up their own trust. Let's keep it simple and keep it separate. What's the harm in them setting up their own trust? Keep it separate. There are many benefits in them keeping it separate. Um, you know, what's an extra trust at this point? Let's keep it separate. I like it a lot better that way, rather than having one document. Ultimately, when it flows down to the kids, if the provisions are the same, we can merge it at that point.
Excellent points. And I do think that it's important for our clients to know that there's flexibility. So in other words, if Agnes does have a GST provision in her will, George, and it's set up correctly, George and Martha can exercise that or not, or part of it. Maybe George has an eye on a vintage Ferrari he wants to buy for $1 million. He can use $1 million that he inherits from Agnes for that, and he can put the other million into the GST, or
Yeah, so
none, or all,
yeah, so
right?
we use powers of appointment all the time in our documents for that very purpose. That, let's provide as much flexibility as possible for beneficiaries. And it could be all or nothing. It could be as little as using $1 million for that purpose, or it could be nothing and let's get everything to the grandchildren.
Excellent.
But inaction is what we want to try to avoid.
So, and just again, one thing we always try and do is make sure that we're being creative and coming up with creative solutions for our clients. So, by all means, um, you know, feel free to talk to us about this. Ask your advisor if this is of interest to you. This sort of lays out a little bit in terms of, time frames in terms of putting something like this together. But that is what we're here for. We're here for you to walk you through these processes and help you implement. Katie, I didn't know if there were any questions that I may have missed as we were talking.
Yes, there actually were a couple questions that came in. The first one being, at what level of wealth today would someone entertain a strategy like this?
I entertain them at very low level of wealth. Wealth doesn't matter for me. I mean, well, it matters, but you do it more just not only the level of wealth, but the creditor protection. I do a lot of planning just to avoid the divorce protection, the creditor protection. It's not just about assets, about what they are worth today. It's also about where they're going to be growing to. So an asset that if it's a business interest that's worth $1 million, but you think it's going to be worth $100 million in the future, that's the asset we're going to place in there. If you think that your son or daughter is going to get divorced in the future, or you're worried about that, we put it into a dynasty trust. With proper GST election. Those are the assets that we type, and those are the types of people that we deal with all the time. It's not just about level of wealth, it's about creditor protection also.
Yeah, and I would add, and I brought this up earlier, but it's also about, what the ultimate flow is looking like. There's a lot of times that what will happen is there'll be an adult child who doesn't have any children. And if grandma or grandpa has other lineal descendants that are grandchildren, in particular in a state like New Jersey, where there is an inheritance tax, and what that means in English is if I leave money to my children, there is no tax due. But if I leave money to my nieces and nephews, there's going to be an inheritance tax due. Now, if those nieces and nephews are lineal descendants of my mom, if my mom had set this up and skipped me, but went to my nieces and nephews, but I get to use it, that avoids that inheritance tax because it technically was never my asset, which is super important for that family that has multiple children, and maybe one of the children or multiple of those children don't have kids, but some of them do. And I think that that's another little planning tool that you can do, that is pretty cool.
I don't want to get too technical on the inheritance tax, but the ability to provide flexibility is key. And powers of appointment, the ability to reallocate money to other beneficiaries, especially if they don't have kids, or to charity. We provide that in the documents. We want to be able to reallocate the money to other individuals if the lineal descendants, if there are none. And that's a key provision, and it's a key point.
Great. Thank you, guys. There we have a couple more questions here. We'll roll through them quickly. Next being, does the trust get funded with non-qualified assets, or can qualified assets be used to fund as well?
So we get this question all the time, and you don't want to use qualified assets. Those that will necessitate a huge tax bill that you will not be happy with, because you have to recognize the gain that year in order to fund the asset. So we'll name the beneficiary as the trust, but we can't actually fund the trust with those assets.
And next one is, can these be set up for future grandchildren, or do they have to be born already?
So we'd like to have at least one child or one grandchild born right now, but we can use it as a pot. We can set them up as pot trusts for the benefit of grandchildren. We do that all the time, so then any future born grandchildren are covered. But we like to at least have one at least alive at this point.
Great, thank you. And second to last one here. Someone mentioned how the word irrevocable causes pause in some clients. How to build the flexibility for the grantors and not just the beneficiaries is this person's question.
So we build in decanting provisions, which is the ability to pour over assets in the future that gives the trustee the ability to make changes. It's not just irrevocable, but we don't know what the future holds. So we give the trustee broad powers to change the provisions. It's not the ability to change beneficiaries. We can't do that, but we don't know what the trust is going to be. The trust laws are going to be in the future. So we want to create the ability for the trustee to make those changes. The power of appointment, which I alluded to before, which is the ability for the beneficiaries to reallocate money. Certain things like that are the provisions that we do and we add and we keep in there so that we have the ability, though, although it's irrevocable, it's really the idea that we can change certain provisions. There's also what's known as a trust protector. You can appoint a third party and another party, unlike a trustee, to oversee things, who can make certain changes if they're warranted. Certain people, that you want to oversee the trust or make certain changes, we can do through what's known as a trust protector.
Great, thank you. And our last question here, I don't think we got to this one yet, is many families have as their estate IRAs and qualified accounts. How should this be handled if not getting these to charitable accounts?
So you guys want to talk about that, or you want me to?
So I can start on. So super simple, like Matt had brought up the idea that a lot of people do like to leave money ultimately to charities. We are a huge fan here of leaving that money directly into a charitable account that the family controls, but have that funded from your IRA. There's two main reasons for that. The retirement account or the qualified account is probably the most tax problematic when you leave it to the next generation, in that it is part of your estate. But you also still have to pay income taxes as the money's being taken out. So if you leave that IRA directly to a charity, or you leave it to a charitable account for your children to give out upon your death, we like that strategy a lot because it takes that asset out of your estate and no one ends up having to pay the taxes on it. So if you just think mathematically, if I have $1 million and I leave that to my children are going to have to pick that $1 million up as income over that 10-year period of time. If I leave that $1 million to the charity, it's not part of my estate. The charity doesn't have to pay the taxes on that. And the kids then have $1 million to be able to give away for all the charities that the family has supported up to that point. So we're a bigger fan of leaving the IRAs to a charity outright, or to a charitable account where the children can make those bequests moving forward. We just think it's way more efficient for you to be able to do that. If not, we would say that sometimes it involves minor children. we say add qualified provisions of some sort of language onto a trust that allow that the trust to be receiving that money, but not have to pay all the taxes in 1 year, but at least be able to space that out over like a 10-year period of time. Because Matt, said it best. It can be really problematic if you have to recognize all of that as income in year one, which can be a problem.
I agree completely. And we'll just, to echo that, and just if you're going to name the trust, we don't want appropriate trustees in there. It's not always the brother-in-law, sister-in-law, or brother that works best. It's the person who can handle finances and who can handle investment decisions. The person who's going to say no to the child.
Yeah.
Great. Thank you guys for addressing all those questions. If there's anything our attendees would like to reach out and talk to directly someone about, you can always reach out to one of us at Nisvachi Wealth Advisors, and we'll get you in touch with the right people. So just want to thank Steve, Damien, and Matthew for presenting today, and also to everyone who joined us. There will be a brief survey in the browser when the webinar ends. If you guys could provide your feedback, we would appreciate it. And we also did record today's session, so we'll get a copy of this recording out in the coming weeks. So thank you again. If anyone else want to make sure you have any closing remarks before we finish today.
Thank you, as always, Katie, and thank you all for joining us, and thanks especially to Matt for his valuable insight and contribution to this webinar, and we hope to do a lot more of these going forward. Until next time.
Thanks, everyone. Have a great day.